At Scube Wealth Grid, we're diving deep into one of the most pressing yet often overlooked risks facing the commercial real estate (CRE) market today: debt maturities and refinancing pain. Over the last decade, the commercial real estate sector was able to thrive, riding on the wave of ultra-low interest rates, easy access to credit, and an investor frenzy fueled by cheap debt. Lenders, developers, and investors alike were able to take advantage of favorable borrowing terms to finance acquisitions, developments, and expansions at historically low costs. However, as the global economic landscape shifts, fueled by rising inflation, the tightening of monetary policy, and soaring interest rates, the landscape for refinancing has become much more treacherous. What we're now seeing is a looming debt maturity crisis, with billions of dollars in commercial real estate debt set to mature in the coming years, particularly in 2025 and beyond. Many of these loans were originally structured with low interest rates and favorable terms that were built on the assumption that rates would remain low, creating a situation where investors and developers are now facing the reality of refinancing these loans at significantly higher rates, often 2-3 times higher than the original terms. For many property owners and real estate investment trusts, REITs, this means higher monthly payments, lower cash flows, and in many cases, negative equity positions. To make matters worse, rising interest rates have expanded cap rates, decreasing property valuations, which further complicates the refinancing process as lenders are now offering loans based on much lower property values. Properties that once had ample equity are now underwater, and owners are facing the difficult decision of whether to sell at a loss, take on more debt, or risk default. This perfect storm of maturing debt, declining asset values, and higher borrowing costs is creating a ticking time bomb for the commercial real estate market. In fact, some experts predict a wave of defaults and foreclosures, particularly for properties that are not performing as well as expected or those in secondary markets where demand is weakening. The pain is already starting to show. Office spaces, for instance, are especially vulnerable, with remote work trends still affecting demand, resulting in rising vacancy rates and falling rental incomes. Retail properties are also struggling, particularly in malls and shopping centers, as e-commerce continues to erode traditional brick-and-mortar retail foot traffic. But it's not just office and retail. Industrial properties are also feeling the pinch, as supply chain disruptions and changes in consumption patterns impact their profitability. Even premium assets in major cities aren't immune. As for developers who have leveraged heavy amounts of debt to finance new projects, many are now caught in the middle of unfinished developments, unable to refinance at favorable terms to complete their work. These developments are often left half-built, stalling construction and adding to the inventory of distressed properties that will flood the market over the next few years. This poses serious risks to the entire ecosystem, from developers to lenders and to investors in commercial real estate. The underlying issue is that while the demand for space in certain sectors, like data centers, warehouses, and multifamily units, remains strong, the capital-intensive nature of these assets and the sheer amount of debt stacked on top of them leaves them highly vulnerable to the shifting interest rate environment. For investors, the challenge is understanding how to navigate this minefield of rising interest rates, tightening liquidity, and increasing risks associated with maturing debt. The risk isn't just about missed payments or defaults. It's about the domino effect that occurs when one default triggers a chain reaction of falling property values, tighter lending standards, and more widespread credit restrictions. For banks and other financial institutions, this could mean huge losses, and for the real estate market as a whole, it could lead to a liquidity crisis, where finding capital to purchase distressed assets becomes even more difficult. However, while this situation presents considerable risks, it also offers opportunities for astute investors. Those with access to liquidity and the ability to take a long-term view of the market could find themselves in a position to acquire distressed assets at significant discounts, whether in office buildings, retail centers, or even multifamily properties. Distressed sales could become more common as owners struggle to refinance or offload properties before they face insolvency, allowing savvy investors to acquire real estate at prices that may have been unthinkable just a few years ago. The key to capitalizing on this market shift is understanding the timing, the players involved, and how to assess the true value of distressed properties in a high-rate environment. Additionally, savvy investors will need to have the ability to navigate the financing landscape carefully, as conventional lenders may be more reluctant to lend, while alternative financing options like private equity funds, distressed debt funds, or joint ventures may present opportunities to secure capital at more favorable terms. For real estate professionals, developers, and investors, the critical lesson in the current environment is the importance of risk management and portfolio diversification. With refinancing risk looming large, those who have concentrated their holdings in highly leveraged projects or assets in areas with weak demand may find themselves particularly vulnerable when their debt matures. On the other hand, those who have taken a more diversified approach and built strong relationships with lenders or alternative capital sources may be better positioned to weather the storm and take advantage of opportunities that arise.